everyone. I'm Ted Oakley, managing partner at Oxbow. And one of my favorite people, and he doesn't even know it, is Felix Zulauf, who is a real pro. And I love to interview people that have been in the trenches and managing money. And he's made some of the great calls over the last 4 decades. And so, Felix, we're really glad to have you.
It's all my pleasure, Ted. Thank you very
Yeah.
much for inviting me.
Say, I want to start it out because you always, since you're based in Switzerland, you always have the best views on what's going on. People are worrying about geopolitically what's going on. They're confused about the Middle East and Russia and Ukraine, the whole thing. You get a different look at it.
Well, I may have a different look. I'm not sure whether it's the right look or not, but I feel pretty strongly about it. We are coming out of many decades since World War II, where the world order was US-centric and unipolar. The US was the dominating force, the dominating nation, and it could discipline everybody during the bipolar world period, where the communist economies really were insignificant in the whole world global context. When the wall came down, that order continued, and the US was the unchallenged leader, a unipolar US-centric world with all the institutions, like the UN, the World Bank, World Health Organization, and what have you. They were all founded by the US, and because the US was by far the strongest nation after World War II, the US dollar was used as the main currency, which became the main reserve currency in the world. That is the world we have left. That world order has crumbled because a new challenger has come up, China. And in the past, when you look at it, whenever there has been a dominating hegemon and a challenger came up, it created a problem, conflict, rivalry, and often war. We have had that situation in the last 500 years 16 times. 12 times out of the 16 was a direct war between the two. One situation was without the war, and 3 others were with deputy or proxy wars. So I think we are in a transition period from the old stable order to a new order, which will most likely be multipolar. And we do not know how it will look like exactly. But I think China wants to have a saying. India will have a saying. Russia wants to have a saying. And Europe, of course, wants to have a saying. And we are in the transition period that is disorder. It's chaos. Everybody is trying to position himself in the best possible way. And this is a situation where you don't have a disciplining world policeman, so to speak. And therefore, all the potential conflicts in the world all of a sudden come to the surface. We had Ukraine, we had Armenia, Azerbaijan, we had Serbia, now we have Guyana, we have Gaza, Israel and Palestine, etc. And there will be more of it. Now, 5 years ago, I started to write about the coming conflicts and wars. And at that time, my subscribers laughed at me and said, "Oh, you are a pessimist, etc." And here we are. We have war in different corners of the world. And I think it will intensify over the next few years. The long war cycle peaks very late in this decade. That means the second half of this decade will probably be quite rough. And the biggest problem that I see is not Taiwan. I think Taiwan will longer term integrate into China smoothly if it is let alone, if the US doesn't use it as a provocation, as it used the Ukraine as a provocation against Russia. But the biggest problem, I think, is in the Middle East. Israel is now trying to clean out Gaza from Hamas, which I understand from the Israeli point of view. The risk is that this Israeli cabinet, which is, in my view, a very weak cabinet, uh, then tries to get after Hezbollah. If they try to get after Hezbollah, Hezbollah is in Lebanon and in Syria. And if they attack Syria, Syria has a military agreement with Russia and, of course, also with Iran. And that means that Russia and Iran will then get pulled in. And if that's the case, then, of course, on the Israeli side, the US will get pulled in. And I think that is the biggest risk I see, that the war could broaden into a sort of a World War III or something like that. That's the biggest risk I see on the horizon. That's geopolitics. And of course, the world economy is also in some trouble. We have the biggest debt burden ever relative to the size of our economies. We have a demographic situation that is not pro-growth. China has peaked in terms of growth, and they are beginning to shrink in population. You know, by the end of this century, China will be down to about 750 million from 1.4 billion at the present time. Europe is shrinking, Japan is shrinking. And when you really look at the OECD plus China, Brazil, Russia, that's 95% of world GDP. Then you see that from the early 50s to the early 90s, population grew about 25 million every year on average. And since the early 90s, that number is declining. And in 2019, I believe we hit the zero level and we are now shrinking. Now, economic growth is population growth plus productivity growth. And if you have the demographic situation that I just mentioned, it's very difficult to achieve the growth rates that we need to keep our economic system stable. And that's what, that's the position we are in. We have a very challenging position, and policymakers, of course, try to achieve higher economic growth, and they are using tools like going deeper into debt, like running larger fiscal deficits and things like that, and it makes the mess even bigger instead of smaller. And that is a very dangerous situation we are in. So I think the next few years will be quite challenging.
What do you see there, Felix, on the Ukraine-Russian situation?
Well, you have to understand that the eastern part of Ukraine is ethnic Russian, the Donbas region. And in 2014, we had a revolution in Ukraine. And according to my information, the US orchestrated that revolution. Victoria Nuland, deputy to Secretary of State Blinken, even said on a phone call, it cost us $5 billion to organize that revolution. And of course, they put in place a Washington-friendly government from a Moscow-friendly government. So it was one of the many regime changes that the US orchestrated in the world. And that, of course, meant for Putin that he would lose the only warm water port in Crimea, in Sevastopol. And therefore, he had to take Crimea. And he tried to defend the ethnic Russians in the eastern part of Ukraine because they were treated badly. And there was a civil war created in Ukraine, the Western Ukraine against the Eastern Ukrainians, which were or are Russian ethnics and speak the Russian language. So that was the situation before 22. And Putin requested many times from the US, actually for 20 years, to discuss the European security architecture because he disliked that NATO kept expanding eastwards step by step and was beginning to knock on Russia's doorstep. You see, uh, and uh, and the U.S. refused to discuss that. And when Putin learned in early February of 22, that the Ukrainian army was preparing an attack against the Donbass, the eastern regions, provinces of Ukraine, the Russian ethnic territory, um, he attacked. And he never wanted to, uh, take all of Ukraine back. The Western narrative that Russia wants to re-erect its old Soviet empire again, I think is wrong because Russia doesn't have the economic means, nor does it have the military means to really occupy such a large territory and then put their soldiers there. It would be beyond what they have in terms of means. So I think what Putin wanted, and you saw that he pulled back after 2 months from Kiev. He wanted Zelensky, the president of Ukraine, at the table to discuss an agreement, and he wanted to keep the US and NATO out of Ukraine. And the two came to an agreement in April 22 in Istanbul. And at that time, they needed, or Ukraine wanted to a guarantor for the agreement, which is the US. And Biden said, "We are not in. You have to continue fighting. We disagree." And then the war really took on a different dimension. Then Russia began to become serious, and that's when they began to destroy part of Ukraine militarily. And that was also because Putin was coming under pressure at home in Moscow, because in his cabinet, the people said, if you start a war, do it right, and so this is the situation we are at. It seems that the counteroffensive was a failure. The Western world is running out of money and running out of weapons and ammunition. They cannot support Ukraine any longer at the same level as in the past, and therefore Ukraine has lost. Ukraine has, in my view, Ukraine's military that was originally 700,000 people and then built up to 900,000 people has lost 500,000 people recently. That wounded, missed, and imprisoned. And recently, state television in Ukraine sent the message out that we lost 1.1 million, and Zelensky intervened and they recalled that message. But it is just a bloodbath, and it is horrible and very sad. And Russia has won that war, and the West has lost. The only open question is what the agreement eventually will look like. I think the agreement will eventually be dictated by Russia. And it would be very good if the US and the West would talk to the Russians and we could finally discuss the whole European defense or security architecture and have peace.
Well, on that same question, if you look at the gold that those countries over there, that Russia, China are buying, and don't you think that relates back to the freezing of those original monies that Russia had here?
Well, that came later. The freezing of the money came later. I think that was a major mistake by Biden because he derates the US dollar as a major reserve currency. And since then, China is a major seller in US treasuries and is a major buyer in gold because they will use more gold as a reserve currency instead of the US dollar. And others in the BRICS plus regions and nations, they will do the same. Uh, I, I, I think if you step back and you look at the world map, you see there is one continent that is called Eurasia. So Europe and Asia is one continental plate. And when you look at that continental plate, there are 4.5 billion people on that plate. So half of the world, or a little bit more. And the trade between Germany and China is bigger today than Germany with the US. And the US fear was that as these guys integrate more and more via trade, we could lose our influence. And then, as if we lose our influence on Europe, you know, we are not the top nation in the world anymore. And I think they needed something to break that process of trade integration. And I think Ukraine was the case they used. And with Ukraine, they provoked Russia to attack, and then they could force Europe into sanction against Russia, and therefore Russia is out of the equation in on that Eurasian continent. And you have to understand that what works is you have technology in Europe, in Western Europe, and to some degree in China, and you have cheap labor in Asia, and you have commodities in Russia. And these together could be a very powerful trade bloc. As you have NAFTA with commodities in US and Canada and oil in Mexico and cheap labor in Mexico, but NAFTA is only 10% of that Eurasian continent. And therefore they try to break that process. And the US is also trying to force Europe into sanction against China, which in my view will not work because China is too important to the European nations. The European nations depend on exports, particularly the Western European nations. And if they would sanction China as the US demands over the longer term, that would backfire badly. So this will not work.
And so, in that respect, economically, looking ahead the rest of this decade, so how do you see do you see the U.S. declining somewhat and those countries increasing? How does that fit together?
Well, I think each region has its own problems. The Chinese have overbuilt their real estate stock. It's you have 100 million empty homes in China. Compare that to a total of 140 million homes in the US. That is dramatic. And with a declining population, you will not grow into that empty stock of homes, and therefore there will be a lot of write-offs, and it will be a long digestion of the problems, and the banking system has to be refinanced. I think they will take time. It's more than 10 years, and that means that China cannot really uh, be a locomotive any longer for the world economy as it used to be in the last 20 years. It will rather be a restraining factor. Europe has a stagnating to shrinking population. It has major problems with the Muslims, to integrate the Muslims, and there are unrest everywhere. There are cultural problems, or problems between the cultures. We have the highest energy prices in the world and have become, in many ways, uncompetitive. Uh, and that leaves the US. You have the best demographics. You have your own energy. You can produce domestically. Europe depends on outside energy. So I think you are the least dirty shirt in the laundry, so to speak. But you have your problem also. You are building up your debt situation, government debt situation, and also in the private sector to a degree that it becomes a hindrance to growth and a restraining factor. And it will backfire in the next few years in the bond market because neither the politicians want to cut back nor the constituencies, because when you ask them, are you okay with cutting the entitlements? They say, no, of course not. And therefore, you need You need a serious fiscal crisis that has not arrived yet. People are talking about it, but what we have seen in the bond market has not been a fiscal crisis yet. We will have a big fiscal crisis and the bond market in the next few years. I think you will see it in the next 3 years or so. The bond market will shoot up to very high interest rates to force changes. And the forced changes could be raising taxes. The US, on average, has lower taxes than the rest of the world. Not as all the countries, but on average, the rest of the world. Your government could sell land. Your government owns a lot of land and things like that, and also make some cuts. Those cuts in entitlements are only possible in a major crisis. And when I say major crisis, it has to be something on the order of what we saw in the mid 70s when New York was virtually bankrupt and things like that. We had such. This is nothing new to the world. It happens all the time. We had it. Most people do not know any longer that the UK had to be bailed out in the 70s by the IMF. So we will see something on that order.
And it's interesting you say that because you look at the 70s, you had the oil embargo, you had, New York and all that. And then you look around now, we have more debt than we had ever had then. And we get this question a lot. And my question to you, and I think you just answered part of it, is what's the end game of that? The end game of that has to be some damage, I'm hearing you say.
Yeah, it has to be painful. It's a major crisis, and only in a crisis of major proportions you can make the steps in a democracy that are necessary to be taken. Under normal circumstances, the political process cannot take that step. You need a major crisis, a crisis that makes every citizen aware of it and probably feels it also. And I think we will get it in the later part of the 20s. Yes.
And so, in that regard, if you look at stock and bond markets, for example, do you see a lot of volatility coming relative to that? That would obviously affect the stock market too. But how do you see that?
I call this decade of the 2020s as the decade of the roller coasters in our markets, where at the end of the decade or in early 30s, when you look back for the last 10 years, your total return will be frustratingly low. But you will have lived through dramatic increases in the stock market and declines in the stock market. Because what I just said about the fiscal crisis and what it means for treasury bonds, treasury bonds could then all of a sudden go to 8% or even higher than that in the late 20s. And that, of course, means much lower stock prices. But they will not stay down there. They will all come back. The stock prices come back. And when you go through such a roller coaster period, it requires a different approach than when you have a smooth, long-term, almost linear rise with little swings, cyclical swings. It requires a different attitude how to run money. And I think you have to have some capabilities to time these, I call them mini cycles or mini cycles in the market. And even if you just can cut out 50% of the move up and you can avoid 50% of the move down, you will end up in a much better position than the guy who stays invested and stays put and suffers through the downs and enjoys the ups. But at the end of the time, he ends up with a very frustratingly low total return.
Which is interesting, Felix, because we both came into the business about the same time. in that period of the 70s up to 82, the markets, all they did was they went up 20%, down 25. It was just back and forth. And if you sat there, like this is my question to you, half our business today, in the industry, have only been through this thing where you just plugged into indexes and exchange traded funds and you did a 60-40 look and you forget about it. And it doesn't seem to us, at least at Oxbow, that's going to work the next 10 years. But I'd be curious on what you're thinking.
Yeah, I absolutely agree. I think that will not work. It will lead to frustratingly low results. First of all, on the interest rates side, I think that 40 years of declining inflation and declining interest rates, and I think we are in the early part of the secular trend of rising inflation and rising interest rates, which will fluctuate cyclically around the rising secular trend. The world that I described geopolitically means that there will be less trade and there will be less efficiency from trade. And therefore, that calls for higher prices and more inflation structurally. And that's what we are having. When you have a 60-40 portfolio, the 40% will have a good time in a down cycle, which will be short and not last very long, and a very bad time in the up cycle, as we just saw in the last few years. And we had one of the biggest drawdown in the bond market in 50 years. I think it was the biggest drawdown in 50 years. And in stocks, uh, you stocks are correlated to interest rates and bond yields because that's the capitalization factor of earnings. And therefore, if the capitalization factor swings cyclically, but in a secular rise, that means that valuation will decline on a secular basis and swing around that decline cyclically. So this is how I see it. And then you have the other thing, these passive investments and indexing. You know, I think more than half of the money invested in stocks today is indexed. And then you have another big portion of actively managed money that is not indexed, but it is closet indexing, where the active managers can charge higher fees, but they run too high a risk to move really far away from the benchmark. And if you take that together, I would guess that you are over 80% in index money. Now, if anywhere in the world somebody wants to index his portfolio to the world stock index, it means that almost 2/3 of the money goes into the US stock market, and 1/3 in the US stock market goes into 7 stocks in today's time. Never, never in history has there been such an extreme concentration in a few stocks as we see today. It's more extreme than what we have seen at the 2000 top in technology or at the Nifty 50 top in 73. It's more extreme. And of course, those who wanted to outperform the index had to overweight those stocks. And that means that once the market begins a correction next time, which I think probably from a top in the first quarter of next year, the correction for these technical reasons could exaggerate on the downsides and magnify the decline. It has nothing to do with the real economy. It has to do with the over ownership of a few stocks that have such a heavy weighting in the index. And I think most investors are not aware of what sort of risk they are carrying in their portfolio. So, yeah,
Well,
volatile times.
I know what you were thinking in 2000, and you were right on the money for sure. And do you feel like now it's a little bit like that? I mean, people are very complacent. They don't mind all this, all this concentration, not really thinking straight. It's interesting. They think things are going to go back just like they were the last 15 years. And so You see a correlation between 2000 and now?
Well, the correlation I refer to is in the concentration of stocks. I think in terms of valuation, it was more extreme then than it is now. And now you have a pretty large segment of the market that is um, uh, valued at the level that is reasonable. So the bigger part of the market is valued at reasonable level, but it's a few stocks that distort the aggregate, and they distort it in a nice way because prices are going up, and it pulls everything with it to a degree. But that overvaluation and excess will be corrected, and it will get corrected. You cannot rise to such a degree and then correct by going sideways. That is not the way markets work.
Well, and I would ask you this about the industry itself. How do you see, and you've managed money this time, now you manage your family office, but how do you feel about I feel as though, and I'm asking a question about this, that the industry itself has gotten really complacent. They do a lot of things that don't really, to me, concentrate on preservation of capital for people. And we've tried to emphasize that, hey, you want to think about preservation the next 10 years. You need to try to get away from, this Wall Street mantra here. But how do you feel about the industry like that?
Yeah, I agree. We have had such a good time in the last 15 years in the market, being long 60/40, that people tend to extrapolate in a linear way. And that is also not how markets work. And the industry, what I think has been very bad for the industry is that particularly BlackRock pushed this ESG standard. And I think what originally was probably thought as a good thing has become an exaggeration, and it distorts many things. It leads to malinvestments and wrong decisions at the highest level in the corporate sector. And I think this is wrong. And the climate wave is overdone, and I think it's cresting. And when 80,000 people from all over the world travel on their private jets to Dubai to in their 27th session to discuss how to change climate, something is wrong. You see?
That is so true. We fly this, spend all this jet fuel to talk about how we can change the climate. And speaking of that, and you've been in this thing a long time, but if you look at public companies today and their boards and what they do, I don't think I've ever seen a period where you had rubber stamp boards that really don't think at all about what's really going on in the public sector today. Is that something you've noticed, or has ever crossed your mind?
Oh, absolutely. I recently talked to the head of the Swiss National Bank. We exchange views regularly, and we discussed the Credit Suisse situation. You see, and I asked him what did they do wrong, because he looked into the whole situation from early on. And he said, they had everything right, because we talked about this climate thing and ESG, etc. also. And he said, on paper, they did everything right. They had everything rubber stamped. Everything was according to ESG. But eventually, the board didn't understand banking anymore. You see?
Which is a good
And
point.
and I think this is the case. These boards today care about not all of them, but many care about so many other things than their own business, that they are not focusing on the right thing anymore. And I think this is not a good thing.
Well, and the other thing I noticed so much, rather than concentrating on organic growth and really building your company up, we've gotten into this mode, particularly the last 15 years, where you've allowed these CEOs and companies just to buy the stock back and change the numbers and, go ahead and create a bunch of stock options. And I just don't think that's been good for the companies or good for the investors. How do you see that?
Yeah, and it's also bad for society as a whole. I think we have tended more and more towards a new feudal system where the a part of the elite, and particularly public company boards and managements and their bodies in government and in public affairs have interrelated to such a degree that they have become a new club, and it's a feudal system, and they care much more about their own well-being than what the job is, namely the well-being of the company, the well-being of the employees and their clients, and the well-being of the citizens. They many have forgotten that in a way.
Well, and it's interesting. Gosh, you describe it the best ever. I mean, that's exactly our point of view, the way this thing has come down here the last 15 or 20 years. And it just seems that at some point, you're going to have to operate, or you're going to have to be in the real world. And a lot of these companies, they've had financial engineering this last 30 years, but they haven't really gotten down to doing business, because I look at their revenues 5 years later, revenues are the same. And so it's interesting the way you describe that. Do you think, in looking at the markets, and I'll wind up here, I just want to ask you this question. If you were, for an investor that's obviously not your size, but just investors out here in the hinterland, what advice would you give? Just generally for the next 5 years, what would be your advice to them?
Well, the most precious asset is to keep an open mind and remain flexible, and not extrapolate the past into the future in a linear way, and find a pro who understands business cycles and market cycles and can help you in timing them. It doesn't mean that you sell at the very top and you buy back at the very bottom, but he can help you to reduce the downside and enhance the upside to some degree. And even if you cannot enhance the upside, but you reduce the downside, you come out as a winner.
And I think people need to keep that in mind. I see today so much risk that people have taken. They're in private equity. They don't know what they own in a lot of cases. In private equity, they're leveraged up in real estate. They're in these expensive markets that they're in. You think those alternatives will come back to haunt them as well?
Well, the problem with the private market and not the public market is that in the private market, you only value those investments at the correct price when you have no other choice anymore. You see? And the rest of the time, you get some sort of value which may be correct, but maybe not. Yeah, and that's the problem with those markets. You only know what you get when the bad days are here again.
Yeah. Well, listen, I really appreciate, Felix, you taking the time. I know you're really busy and you don't do a lot of interviews, but I'm glad you did this one, because I think people will get a lot out of it. And I'm hoping maybe next year we can visit with you again.
That would be great. That would be great. Thank you very much for having me. It's been a real pleasure. And hopefully we can meet someday in person.
All right. Thanks a lot then, Felix.
Thank you, Ted. Take care.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.